morning. I'm Grant Swartzwelder, President of OTA Environmental Solutions and your host. Appreciate you joining us for Oilfield Strong webinars that started back in March of last year with the quarantining that went on and has continued to go. We have made some changes with it where we'll be doing it every first Wednesday of the month at 1:30. That way we have a real schedule that you can put on your calendar and look forward to that particular date. If you miss or want to share this with anyone else, please go to our YouTube channel and just search for OTA compression. All our past presenters are on there, and so will this one in the next day or so once we get it loaded up. Our speaker today is going to be talking about two things that seem to be the hot areas right now, and that's ESG and that's analytics. You can't seem to be in the oil field without talking about one or both of those things. He's done a fantastic study on independents and looking at how their performance of emissions have compared their emissions performance and benchmarking that. He also is director of research for the U.S. Upstream, so he's got a lot of good input for the industry as a whole. Ryan Duman is with WoodMac, as I mentioned, research director. Before that was with Ponderosa. I just found out that, from that title, you already know he's intelligent, but then he has been quarantining up in Jackson Hole. So if there was any doubt whether he was smart or not, that all went away because he definitely picked a better place than I did. So congratulations on that, Ryan. Good job on that. But with that, let me just start off. If you wouldn't mind, I don't know if probably a lot of these folks haven't had a chance to look at your study, but if you would kind of give an overview of that and kind of some of the conclusions and what you think some folks might be interested in hearing on that, and we'll kind of get started that way.
Yeah, absolutely. I mean, first of all, thanks for having me on the webinar today. Glad to be able to share some of the work we've been focused on lately. So, as Grant mentioned, my name is Ryan Duman. Traditionally focus on a lot of the standard upstream topics, as I was telling Grant, things like supply forecasting or asset valuation and stuff like that. But as I'm sure similar to many of you on the call, found we couldn't walk into a meeting, the past year or two and not have it somehow get into ESG or emissions topics. And so as part of that work, like Grant mentioned, we relatively recently, released a report looking at U.S. independents and how they're lowering their emissions. And so we focused in on U.S. independents as the group to look at, because I think they're going to be a peer group that we're all going to want to watch over the next few years. And there are a few reasons for that. So first, we're looking at a set of companies, that either already have or are on track to have pretty solid financial health. So we're looking at prices now in the 60s or upper 60s today. And so the ability to shore up those balance sheets and just routinely churn out a good amount of cash flow is going to be important, since cutting emissions, it's going to be expensive. And so you're looking at companies that can frankly afford to start budgeting in some of these big projects starting today, and they already have done so in many cases. And so they're going to be some of the first to be able to say, okay, here are the ones that are going to be the most effective, that we're going to be able to lower costs most in, and then here's the ones where we can really see scale and opportunity to move the needle. But then from another angle, looking at it as, even though the majors and Euro majors tend to garner a lot of the headlines, I think the independents are going to look at tackling the energy transition or the path to lower emissions in a bit of a different way. So really what I mean there is not so much in the field if you're talking about, say, Exxon versus Pioneer in the Permian, but rather from more of like the corporate strategy standpoint. It doesn't have to be as dramatic for companies like EOG, Conoco, or Pioneer, for example, to have to divest the Permian assets to jump into offshore wind. I mean, that's a conversation that maybe one day we'll have, but rather we see these companies playing a role in the energy transition by sticking to their core competencies of drilling for oil and gas and the lowest cost manner that they can, but just doing so point forward with a whole lot fewer emissions and better environmental performance. And so when we started looking at these companies, really looking at where they're at today, where they're trying to go, and how do they plan to get there. So 3 simple questions that ultimately led to a whole series of additional questions there. And so some of the big takeaways is that it's too early, frankly, to say which companies are performing the best and which ones are most likely to achieve their emissions goals. When we look at where they're at today, and for some companies that are talking about net zero or other aggressive targets, it's hard to make the math work out and how they'll actually get to the end goal. Not to say it's not going to happen, but we're looking at a lot of big question marks, whether it's with how many I believe pneumatic controllers to be swapped out. How many CCUS projects are going to be needed, and what's all that going to cost, and who's going to implement it? So there's ways that we see the path forward for sure, but question marks as to how that actually gets implemented. And then also just the focus on the different types of emissions, a lot of effort putting into flaring and venting, which is fine and really encouraging to see. And we see that the industry, very capable of meaningfully reducing those emissions, but then also wanting to see much more effort put into electrification, especially electrification with renewables. And then, you start thinking longer term, seeing a lot of effort or at least discussion into CCUS, but that's going to be one of those necessary things that's going to really help us see companies get to net zero. And again, we're not quite there yet, whether it's from a technology or cost standpoint, but we certainly see that these companies are extremely committed to trying to go the distance.
Okay. Well, thanks, Ryan. Just for clarification, I think it was 6 companies that this was focused on large independents.
Yeah.
Go through those so that people have a perspective of which ones. You've mentioned some, but
yeah, absolutely. So in this study, we're talking about Diamondback, ConocoPhillips, Pioneer, Oxy, EOG, and Devon. So these are companies, I picked them for number of reasons, whether it was from just what their financial standing was, companies that have talked a lot about and trying to improve environmental performance, or just companies that are leaders in, say, Permian or general U.S. upstream.
Okay. Talk to me about how, if you have some insight of how they picked, each of these companies kind of picked their targets, because it seemed like it was their targets and how they're executing seemed to be kind of not all over the place, but definitely varied from company to company.
Yeah. No,
was there a method to the madness of how each of them picked that out?
Well, I mean, you're right. There's a very wide spectrum in terms of what the targets look like for these companies. You have, on the one hand, companies like Oxy, EOG, and Conoco talking about net zero targets, and then companies like Pioneer and Diamondback, they have aggressive targets, but not quite that bold. The short of this, I don't know if there's necessarily a method to the madness. And I think in a lot of cases when you talk to companies, it's setting targets to show stakeholders that they're actually serious about cutting emissions, and generally seeing companies with more diversified or especially international portfolios having some of the bolder targets. So, Oxy and Conoco being the key group there. And in some cases that can have to do with where your capital is coming from, but then also just needing to be on par with some of the others elsewhere in the world. So obviously the energy transition and this push for lower emissions is a bit further along over in Europe, for example. So if you have, say, North Sea assets or exposure over there, then you're going to have to be a bit more aggressive than if you're a Permian pure play. But I think when thinking about the targets in that spectrum, it's encouraging to see. But the risk then, when we talk to clients, is that we don't know which target, whether it's net zero or something scaled back, or which time frame is necessarily going to be either rewarded the most if a company achieves it, or penalized if they miss it. And the part that I think starts to spook some people, especially in the finance side, is we're seeing real dollars being put at play here, several $100 million to the $1 billion type of price tags. And so with the goalpost changing in some cases for what those targets need to be, you'd hate to have to go tell investors that, oh, we were chasing the wrong metric, and all of a sudden we spent all this money that isn't going to actually get us any closer to net zero. So there's going to need to be some sort of consensus in terms of what the right targets are. And one hunch is that seeing a series of more intermediate targets is a way we could get there. Because if you're talking 2050 or 2040, in some cases, you're talking about timeframes that are outside of the remaining career for a lot of folks in the industry and a lot of the CEOs and boards that are in place. So it's fine and good to say this is where we're going to take the company, but let's start to see what you can do by 2025, for example, and see what the reactions are then.
And is that your thought that they need to focus on 2025, or are you seeing those 6 companies focusing on 2025? Because some that I've seen have 2030, 40, and it is way out there.
Yeah, exactly. So that's more my thought, but then also coupled with what we're hearing more and more from the regulatory standpoint. So if you look at the goal to eliminate routine flaring and what New Mexico's put out there and different ideas for gas capture targets that are being put out there, plus just what the Biden administration has talked about with emissions reductions for the country by 2030, you start to see that there's increasing risk that the timeframes need to creep forward for these companies, and talking about several decades out may not cut it, and so needing to see what are you doing in the next 5 to 10 years is almost check-in points, I think would be a good way to put it.
And do you think that's the regulatory, the Biden administration, or do you think it's the capital markets pushing that? And it's really, I guess, both, but I always thought it was more of the capital market side pushing that, saying if you want capital, you have to do this. But
yeah, so I think the capital markets still have the biggest sway right now, but in this is a desire to avoid policy risk from the companies as well. And I think that kind of circles right back into the capital providers, where you want to make sure these companies aren't setting themselves up for risk to all of a sudden incur fines or delay development or anything like that.
Okay. Back on the targets, you've mentioned net zero a couple of times, and that is kind of the big buzzword right now. Is that, from your perspective, is that the target or the preferred target that's out there right now, is net zero by a certain period? Or, because there's also things, greenhouse gas and flare intensity, and there's others that are maybe subsets of that. But
yeah, I mean, it does mean that net zero is quickly become the gold standard, if you will, in terms of what companies need to be looking at. Within that, all the companies we look at have some sort of goal to eliminate routine flaring, whether that's by 2030 or aspiring to do so by 2025. And so it kind of falls within that broader bucket if they have a net zero target, but it appears that that's where companies need to go. Now the tough part then is net zero in what scope of emissions. Some companies talking scope 1, some companies talking scope 2, and then as you get into the major, scope 3 starts going in there more and more. But I think generally having some aspirations to get towards net zero is going to be increasingly common to see from the sector.
And so to get to net zero or to achieve any of these, you have to have confidence in the data and the metrics that you're calculating against or presenting. How do you think those companies are doing, or the industry's doing, as far as really understanding and being able to, with confidence, provide the data or the metrics to say that they're doing those things?
I mean, I think it's a dramatic improvement from where we were at, just a few years ago, but still a ways to go. It's not as robust as, say, gathering production data or looking at some of the more typical well metrics that a lot of us are familiar with. The methodologies in some cases and how emissions are being captured and presented can vary quite widely. And so, if anything, I think the need for standardization and consistency is one area where, I guess coming at it from more of the analytics perspective, we'd love to see improvements there. but it does appear that, progress is being made, but there's still, again, confusion sometimes when we talk to folks about, okay, what is the best data set that's out there. So for example, more and more stakeholders, whether it's investors or even folks that are looking at the regulatory side of things, increasingly pushing for more granularity as well. So it's one thing to say, okay, here is Conoco's lower 48 emissions, but it's going to be increasingly important going forward to understand how the Permian versus Bakken emissions look, and then even more important to dive into county by county. And so it's a big ask on these companies, but also one that is definitely coming, if not already there for a lot of them.
And I got to believe a big driver of that is, are they focused on crude or are they focused on gas? Gas is just cleaner and probably will give you better metrics with that. So your mix of what you're producing probably drive that quite a bit.
Yeah, no, absolutely. And I mean, it's always it can be a slippery slope. And it's not saying any companies are necessarily doing poorly, but the more data and transparency you provide, the more holes you can start to uncover, if you're getting folks that are looking into it. It's just no secret that flaring in the Permian or fugitive emissions or things like that have been a big black eye for the industry, as Sheffield is so eloquently put it.
Mm-hmm. What the thing that always I don't know, amuses me or concerns me is that it seems like you have the majors really pushing for things like carbon tax, things like that. And I assume that they're able to handle that better because they're either diversified or larger. Then you go to these large independents and you talked about how they're able to handle a lot of things that on the emission side, but there's a lot of companies below the size of those 6 companies you mentioned. And how do you think this is all going to affect those folks? Because they don't have the staffs, they don't have the systems.
Yep.
But I guess at some point they're going to be held equally responsible.
Yeah, I mean, it's a great point. I mean, so and that's where, like I said, one of the things that attracted me to think more specifically about the independents was they're not going to think about it the same way as the majors. Because so often we go into a conversation and a company might be like, wait, so you're telling me I need to get rid of all my oil and gas assets and now become get into wind farms? And I don't think that's the case at all. And so with each, I think, either size or peer group, you start to have differing asks on everyone, and this isn't one size fits all type of situation here. So I think the important thing for especially smaller companies to realize is that not every company has to have its own CCUS project, for example. It's great to see companies like Oxy talk about direct air capture technologies or something that's more bold distributed renewables projects, but that's not something every company needs to do. And so for, I think, smaller companies, the ask is still going to be to have ambitious targets to cut emissions. I don't think you can be a public company or even a private company that aspires to be bought or go to market at some point and not have a better record. But I also think the ask is different, where it could be in some cases as simple as just more efficient operations. So if you think about it, like just drilling wells faster can inherently cut down your emissions there, or things like water management. We're talking emissions here, but there's a whole nother side of things where you can still improve your environmental performance, and that like I said, just best business practices can really go a long way. And it's one where I don't know if all companies will necessarily have to aspire to net zero. But if you don't have to go quite that far, then all of a sudden you are talking about a whole set of different things. But I do think, regardless of company size, there's going to be a bigger push for electrification of operations and to just remove some of those inefficiencies, especially with logistics and all the truck trips and things like that, and just trying to not have as much diesel consumption for generators and some of these things that are, I'd call them the low-hanging fruit part of the goal to cut emissions. But the asks and what we hear about from the majors and large independents isn't going to fall on everyone.
Well, there's I was talking to production superintendent for one of the companies in your study, and they're talking about $15 million this next year just for moving into instrument air. And that's the bleeds and all that, that's important, but that's a minor thing. And to spend that much money on it,
Right.
that shows commitment, but that's also something that a lot of companies can't do. So these larger companies, large independents are held, I'm sure, to a different standard because they are public. They are more of a national footprint, or not footprint, but national capital print.
And I think there's an opportunity for the large independents to have a little bit more leeway and budget to experiment with some different technologies and strategies, and then, like I said, show others in the sector, what options provide the most effective emissions reductions at the lowest cost possible. So for some of the smaller companies, it may not necessarily be in the best interest to be number one out of the gate, but rather see and look at, oh, this is what EOG is doing and it's worked really well for them, but Pioneer just cut the cost by 25%. So maybe we follow in that path, and so letting some of those guys almost foot the bill for some of the early learnings.
You mentioned Oxy, and I believe they announced that they're going to do a project trying to sequester CO2, but it also kind of fits within I guess they're in a unique position because they have CO2 type floods. And so they're able to do that. Do you think we'll see these other large independents move into carbon sequestration type projects or things like that to get to the net zero? I know the larger companies, Exxon and Shell and all those folks are talking about lots of money, BP, and shifting a segment of their business to that. Do you think that'll trickle into these large independents?
I mean, I think carbon sequestration in some form or another is going to be necessary for companies to hit the net zero target, that or they have to pay dearly for a significant number of carbon offsets. Now, whether they need to do the projects themselves or just be a third party in a company like Oxy's projects or Exxon's projects, that's the big question, because it is a hard one to envision companies step out and need to all of a sudden develop this new core competency in an area that maybe they're unfamiliar with. So like you said, Oxy or Chevron, for example, or Exxon, all in very good position to be leaders in CCUS or CCS. Not to say that companies like EOG couldn't figure it out or do very well there, but it's going to be expensive and probably one where being first mover, it could be rewarded handsomely, but also big risk can have big failure too. So all this to say, I think it'll play a role, but it doesn't have to be something, like I said, every company has to have their own CCUS program.
Yeah, seeing the uncertainty of these projects in the sector as a whole does seem like that becomes very risky capital that you're investing. And so how do you think the capital markets looks at that, where you're in one way they're needing to net zero, they need to do those, but then if you go put a chunk of money into these projects that are unproven or who know, kind of still being formed.
Yeah, it's a conundrum. I spend a lot of time with the capital providers, and I mean, it's something that it's at odds with. You want companies to try and get to net zero, but at the same time, like I say, you don't want to see them pour a whole bunch of money into no return type of projects, especially when you look over at, say, their portfolio of options right now, and with oil at $68 today, I mean, there's a lot of very high return projects. So I think it's balancing, what is the ask here, and how do you mitigate some of that risk with the opportunities that also exist that are, I'd say, significantly lower risk, but could generate quite a handsome return.
OTA does various flares and combustors and repairs equipment. So we see out in the field a lot of improvements that can be made and are being made. But then you just look at it and it's like, those are they material enough? Now, if you do it over a large company, maybe it becomes that way. But if you're really trying to make an impact, and from a PR standpoint or from a net zero standpoint, yeah, it helps to make sure your flare is lit, but it's almost like you need to do one of these larger sequestering type projects or or something more, or sell a bunch of your assets that are more emissions dominant. You kind of need to make a larger swing at it.
Yeah, I mean, I think it's a good point, because it's something that in a lot of cases folks aren't focused on the sources of emissions enough, because exactly say, if you can reduce all flaring emissions, let's say by 100%, that still doesn't get you to net zero or even close to it, And so it's looking at, okay, what is actually going to make the biggest dent for a lot of companies? It's going to be tackling the combustion related emissions, and so then that comes to in a lot of cases electrification of operations, and so I look at it as it's good to see the effort put into flaring and venting in particular, and it's something where a lot of companies seem in a position to cut those emissions significantly and do so at a relatively low cost, because once you start moving into electrification, you're talking about bigger price tags, and it's also harder to do, especially in some of the remote parts of the Permian. And that's where you do start talking about, needing some distributed renewables in the field for some of these companies. And you're talking about the need to see wider adoption or proliferation of e-fracs, for example, and trying to figure out, who pays for some of that is it's a head scratcher, because I think some of the E&Ps would look to OFS sector and say, look, you're on the hook for being able to do this, but then they say, well, look, you just kind of have pushed for the lowest costs and maybe ever, so we're not in a place to go out and spend 25% more to have an electrified spread. So it's a tough one, trying to figure out the dollars and cents part of this, and I think as you start to move into the areas that make the biggest dent in cutting emissions, it gets more costly and difficult.
Yeah, it's going back to kind of how these large independents have handled it. Talk to about how they handle it from a proxy or a annual report standpoint. I don't know if you kind of looked at those factors, but it seems like they're in an awkward spot where if they go and do too much, that could bite them, but they need to do some to meet the market. Are you?
I mean, it's an interesting one, because I mean, anecdotally, you hear stuff where companies say, folks who work at some of these companies will say, look, we're not trying to be number one out there, but we're also not trying to be last. If you can be middle of the pack, that could be the best place to be. You're not showing the market, I'm spending the absolute most on this, but you're doing enough that everyone's happy. But that's also a tough spot to be if we're looking for the sector to make progress. I mean, if everyone ran a 10-minute mile and wasn't trying to win the race, then you're not going to see everyone perform as best they can. So I mean, it's a really tough spot, because I mean, then you also look at what happened with Exxon, for example, and if you're not doing enough, then the activist investor risk is certainly out there, and it's very real. So I think that goes back to the target zone and trying to figure out where's this consensus sit for what's the best target, what's the best way to tackle this. Because even though investors in a lot of cases or capital providers are demanding these changes, it's not with enough detail for companies to say, okay, if I do X, Y, and Z, I'm in great shape. It's a lot of guess and check, I think, still.
And I appreciate the segue you provided to Exxon, because obviously with Exxon and then Shell also, there's been some over the last week, some decent announcements where outside forces are forcing these companies to do things. It would seem like it'll start there, but it'll trickle all the way through to these 6 large independents and even beyond, where there could be activists trying to get on their boards and really putting a lot of pressure. Is that a fair kind of?
I mean, so I think the activist investor risk is very fair. I think what happened with Shell and the Dutch court ruling they need to reduce scope 3 by a greater amount, that's one that I don't think we have seen any U.S. courts go that far. Not to say it's not possible, but I don't know if that risk is quite here yet.
Well, you've got New York City suing, isn't it Exxon?
Yeah, I mean,
for
so suits have been filed, but I don't think any rulings have suggested
No,
that.
that's true.
Really.
That's true.
But then you look at Kimmeridge, for example. They came out and like some conversations and talks that Mark Viviano has given and pushing for better environmental performance as one of the pillars for what they'd like to see the sector focus on. And I think they have stakes in companies like PDC, for example, and Ovintiv, and those companies have done a lot to improve. So I think absolutely there's risk that trickles down. It's not just the majors that are going to get the brunt of the push to be greener.
Well, here's a hot sports opinion question. If you all of a sudden you had to have a financial expert on the board, do you think at some point you're going to have an ESG or an environmental expert on the board?
I would think that's already something that's being discussed in I think most boardrooms, if not every boardroom, as to what does that part of the diversity picture look like here, at least from expertise diversity, because that's what engine number one was pushing for with Exxon. I think it was a wind and clean energy expertise, and then you look in there, there's not activist investor, but shareholders also voted for Chevron to do more with scope 3 emissions since they didn't have any targets out there. So I think as more and more of these situations come to light and are highly publicized, probably a fair number of companies that would want to get ahead of it. And that could be a good way by saying, look, this is what our board makeup looks like now, and we're already ahead of the game.
And I guess the beauty of that is, since there's really no experts out there, you could become one overnight and just become famous.
It's a tough area where it's something that I think is so new for a lot of companies and sectors in the economy, just more generally, that it's hard to know. Like I said, what does good look like? What does success look like here? And I don't know if we've seen any oil and gas company get close to net zero just yet. So, we don't know how anyone gets there either. So, it's big problems and things that folks will need to tackle, but you're right. It's an area that it's not like you can just call up a production engineer and have some answers.
Similar to the proxy and some of those questions, what about executive compensation and using ESG as you're seeing that within, who is it, Chevron or a couple others that have talked about that or doing something about it? But
yeah, and I feel like more and more companies are weaving that into executive compensation. The interesting point there, though, when we've talked to a lot of companies about this, is that executive compensation is important, but the other thing that seems to be missing, and when you think about the cultural element of ESG and cutting emissions, is what about rewarding the employees and the rest of the company, if you hit these targets? Because right now it could be seen as a negative if you're a production engineer, for example, and you have to allocate some of your budget to these projects where you theoretically may not have the same return as if you were able to just go optimize the production from some of these wells. So the cost sink is very real, and if you're trying to make your team look good, the incentives aren't necessarily aligned, I guess, at the worker level just yet, and so it can cause some issues in terms of how this gets done.
Yeah, no, I can appreciate that. If you have any other comments about ESG, please offer them. But otherwise, I'd love to get your input, since you got the fancy title of Director of Research for U.S. Upstream, that if you see any kind of more macro trends associated with that our audience might find interesting.
I'd say a lot of it is stuff that most would be well aware of. We continue to see reinvestment rates fall for these companies. I think for the companies in our coverage universe, so all major public companies, it's below 50% this last quarter, which is astonishing considering, just a few quarters ago it was over 100%, so the companies are doing really, really well in terms of making good on those investor demands. And then we're looking at this interesting situation now where from a supply standpoint, could be quite muted, even though prices are where they're at today, but the cash generation could be better than we've ever seen it. So at what point does the grip on the budgets for E&Ps loosen up where they can actually put more into the drill bit and come back? Because it's in our opinion that it's not going to last forever, that you have to keep a reinvestment rate at 50%. At some point, companies are going to want and need to grow. But
what about on the distribution? Because we've got a couple of these companies that are talking about distributing over a certain amount of money back to the shareholders.
I think
there was a flurry of that, and then it seems like it's not quite as active. But tell me if that.
I think as we play this forward, and you get more and more companies getting into a position where their leverage is in better control, and you are churning out this large amount of cash, that the special or variable dividend becomes more commonplace for an increasing amount of companies. The part that starts to become interesting too is that even though you talk about the wider market and the equities that are out there, and oil and gas has not felt the love, if you will, for quite a while, yet you look at the returns this year and where the sector's poised to go, could be a pretty interesting one to see some of the companies, or funds rather, that have shunned oil and gas, whether they can ignore the returns.
Yeah, and then it's an interesting mix between the returns versus the environmental aspects. Not to be I don't know, a little forward here, but it seems it's easier to be down on the industry and really hammer them on environmental when your returns are, in the single digits. You start getting that up to double digits. We'll see how dedicated everybody is to the environment.
Exactly. That's like I said, if you're going to spend $1 billion right now, if you're one of these companies, to spend it on basically eliminating all routine flaring, for example, versus drilling a whole pile of new wells at $70 a barrel, that starts to become a pretty difficult decision.
I think those rates of return are very, very different.
Yes. Yeah, exactly.
So it's well, good, Ryan. Any closing thoughts?
No, I think, just generally it's one where when we look at the path to lower emissions and better environmental performance, it's an interesting point in time where we see that all these companies are moving in the right direction, but the question marks in how they actually get there are still quite substantial. So it's one that it can sound, I think, negative at times, but I think it's an area where we see a lot of ability for progress to be made pretty quickly too.
I would agree. Audience, appreciate y'all's attendance. OTA Environmental Solutions is focused, as the name would imply, on all of these subjects, from fixing flares to environmental consulting. So if you have any questions and that we could help you with, we'd be delighted to be of assistance. With that, I urge you to attend the first Wednesday of July, when we'll have Doug Dormer, who is formerly with Cardinal Midstream, and he'll be talking about the environmental aspects on the midstream side of the business. So it'll be a slightly different perspective, but clearly one that has a huge effect. And he's also looking at various carbon sequestering type projects. And so it'll be interesting to hear his comments on how to look for those, how to value those, how to try to make money with those. So stay tuned for that and put that on your calendar. But with that, Ryan, thank you very much for your time and your thoughts, and appreciate everyone's participation. Take care.